Today we're going to look at sources of finance. We're going to define some things just to start off with. So short term, I'm going to say it's up to 12 months or 1 year. Medium term is 1 year to 5 years, and long term is more than 5 years. Just to start off with a couple of simple definitions. Capital expenditure is spending on fixed assets, such as cars or equipment. Revenue expenditure is the cost of making the products, for example, like the cost of goods sold in your profit and loss account, or maybe the cost of maintaining equipment. Now we're going to look at the difference between internal sources and external sources of finance. Internal sources are things like the owner's money. The sole trader will rely initially on their own money, okay? And that money will probably be put in for the long term. Then we have retained profit. After the company has made profit and then paid dividends to the owners, they'll be left with retained profit. A lot depends on the strategy of the business, the management of the business, as to whether they do pay dividends or not. So for example, Amazon have seen their sales grow by 182%. The share price has grown by a lot more than that in the last 5 years. They pay no dividends because they've got big plans for the future. So they reinvest all their profit. Nestle, on the other hand, you can see Nestle sales worldwide in 2016 were about $90 billion. Nestle makes a lot of profit, all right? But they pay a lot of dividends as well. Okay, because they're a relatively mature business. They sell lots and lots of heavily branded processed foods. Okay, this is also a product of an Nestle Skinny Card. Business can sell this asset. So June 2017, Nestle was considering selling its US chocolate business. All right, and this is an example. And sales during 2016 were something like $1 billion. So it would have been able to sell those businesses for a lot of money. All right. Now, why do they need the money? There are probably a variety of reasons. It could be a short-term issue. Maybe Nestle had lots and lots of debt which fell due and they needed to get money very quickly. Or maybe they were thinking, we'll take this $1 billion and invest it somewhere else, maybe take over another business. Maybe a company in a healthier sort of food section of the market. Now, then we have external sources of finance, shareholders or PLCs. When a PLC is advertising, trying to attract shareholders, obviously they're external to the business and they will maybe be investing for the long term. Disadvantage about issuing shares, it can take time and it does cost money to issue shares because there's lots of legal fees and fees involved with the various stock markets. Otherwise, companies can borrow money from banks. Obviously, you have to pay interest on that, and depending on what is being borrowed, how much is being borrowed and what is being borrowed for, that could be a medium to long term source of finance. Overdrafts are generally, if, let's say, I go along to my bank on the 28th of September and I say, I've got no money left, can you allow me to go into a minus until I get paid on the 30th of September? The bank may say yes, but then I have to pay more interest, and it is more expensive than a loan. So it doesn't really make sense for a business to have a bank overdraft and permanently be in bank overdraft for many, many years. It's a lot more expensive than taking out a loan. But nevertheless, it is a very, very short-term solution to a finance problem. Then we have trade credit. Businesses allow customers time to pay for products or services, maybe say 30 days. This is England's biggest supermarket, the UK's biggest supermarket. It buys lots and lots of stuff from suppliers. But sometimes it has been very naughty. Okay, so this is taken from the Telegraph in the United Kingdom. You can just about see this down here. The Telegraph, Tesco, encouraged the staff to deliberately defer payments. The sums were significant and the length of time taken to repay them was too long. Tesco's buyers, i.e. from suppliers, frequently sought to use money owed to a supplier as leverage in negotiations for future agreements or promotions. A lot of the people who supply Tesco are not very powerful. Big companies like Procter & Gamble, Unilever and Coca-Cola do have some power over supermarkets. People, when they go to the supermarket, expect to be able to buy Coca-Cola. They expect to be able to buy Pantene hair shampoo, which I do use, you know. But if you're a little business and all you're doing is maybe supplying Tesco with fruits, or say tomatoes, for example, Tesco probably is a great range of choice of people who can supply them of tomatoes. Tesco doesn't have a choice as to who supplies them with Coca-Cola. It's Coca-Cola. All right. Therefore, sometimes big companies don't treat their small suppliers very well. Okay, and so in many countries now, laws are being passed to try and stop the big companies from abusing their power over their suppliers. Okay? Now, then we have grants. Quite often governments give lots and lots of money out for a wide variety of reasons. Trying to explain the difference between grants and subsidies, as you will see here, is a little bit confusing. Because basically both involve the government giving money to businesses. Alright? So for example, the government may give lots of grants towards trying to improve literacy. So that might involve building schools. Obviously then lots of businesses benefit because of that. Or reducing unemployment in poor areas. So for example, the government in the UK wouldn't give finance to build more and more businesses in London. They may sort of give more finance to the north of England, but it's maybe higher unemployment. The building of infrastructure. So those should be long-term sources of finance, because obviously it takes a long time to build roads, it takes a long time to invest money in schools and to get rewards. Subsidies, quite often more sort of short-term based. Alright, so the film industry in many states in the United States is very, very, very heavily subsidized. Very little actual filming still occurs in California, where Hollywood is based. Lots of the states now offer lots and lots of subsidies for films to be shot in their home state or home city. Okay? Amazon at the moment is looking to open a second headquarters somewhere in North America. Could be Austin, Atlanta, Toronto. The types of amount of money they may be requiring could be huge. They'll probably be shopping around those big cities to see what incentives will they be given, whether it's about taxes, whether it's about the city building better infrastructure, etc., etc. We don't know. But nevertheless, they will be trying to get as much out of the government as possible. Whether it's actually a good thing for each of these three cities, economists have not been able to prove, but nevertheless, that's something they'll be trying to do. And in many countries, farmers receive lots and lots of money, which helps them lower their costs. So they, in theory, become more competitive. In many countries, they believe in food security, okay, i.e. that the country should be able to provide its own food. Okay. Next, we have the debt factoring. You could see this in a movie. Somebody owes somebody money, you send along somebody, you shoot them. That's very funny in movies, but it's not funny in real life, because if you shoot someone because they owe you money, you don't get the money back. Alright? So essentially then what happens is, with debt factoring, one business sells its debt to somebody else. It means you're maybe able to collect, say, 70% of how much is owed. The factoring company then chases the person who owes the money, and they make their profit because they collect 100%. The 30% is like their gross profit on that. And obviously, this will help the original company's liquidity, because at least you're getting 70% instead of 0%. Alright, so that would probably be a short term. Leasing is where you rent like a fixed asset, like a car or a computer. So as newer models of the car or the computer come out, then they get replaced or updated. Alright? Generally speaking, if you rent something, you pay for each month, but the cost is probably more expensive. So let's say a computer costs $2,000 if you just buy it outright. If you're leasing it, its cost may eventually say up to $3,000 or $4,000. Okay. Then we have venture capital. Venture capitalists invest money into risky projects. If I have a very great idea that's got lots of potential risk and also lots of potential reward, banks may turn me down. So venture capitalists may well be willing to put lots of money into my project. Now they may lend it and eventually have to repay it with interest, or they may want a share of the business. Okay? Generally they come in, they offer finance at a slightly later stage in development, and say business angels do. Generally speaking, business angels invest less money than venture capitalists, and they come in at an earlier stage of development. Okay? But nevertheless, both tend to be putting money in for the long term. This is the difficult part. When you're doing your examinations, a lot will depend on the information in the case study. These are just some general sort of guidelines as to using a particular sources of finance. So please use the case study. Alright, so we have the factors affecting the choice of finance. As I said earlier, if a business needs finance for a very, very short period of time, say 2 days, Okay, they're not going to go in and ask for a bank loan. They're going to ask for a bank overdraft. Okay, risk. Banks are not going to lend to exceptionally risky projects. The entrepreneur will probably have to go to a venture capitalist or business angel. How quickly you need the money? If a business has an opportunity to take over another business, but it needs a large amount of money and doesn't have enough retained profit to actually purchase that business, it might be easier to go to the bank and get a bank loan, because the bank should be able to lend the money a lot quicker than it would take to actually go to the stock market. Okay, it's going to take maybe 6 months to get money for new money from shareholders. Right, the bank might be able to give you money like almost instantaneously. The state of the economy. If the economy is doing really bad, obviously banks are going to be less likely to lend. If the economy is doing really, really well, as it's doing now in 2017, banks are probably going to be more likely to give lots and lots of money to businesses. Okay? And you can see there I spelled running wrong. Okay? Then the size and type of business. Sole traders are generally riskier, so they will obviously be able to borrow a lot less, probably have to pay higher interest. PLCs obviously can borrow a lot more because there's less risk attached, and they probably will have to pay a lot less interest. And then finally, we have here, is it a highly geared company or not? Highly geared means the company already has lots of existing loans. And in a case like that, the bank is likely to say, we want you to have the owners put more money in rather than us putting more money in, because obviously the banks put more money into a highly geared company, it's the banks taking the risk, not the shareholders. Okay, so that's finance. We hope you enjoyed it.